In today's video, we're pitting the S&P 500 against an intriguing two ETF portfolio, SCHD and SCHG. Does this duo outperform the S&P 500 when it comes to total returns, risk-adjusted performance, and income generation? Over the last decade, could choosing this combination have left an extra $5,000 in your pocket compared to sticking with the classic S&P 500 ETF? We've run the numbers, and the results might surprise you. If you're serious about optimizing your portfolio, hit subscribe now so you don't miss these deep dive comparisons. Let's start by looking at why the S&P 500 is such a popular benchmark for investors in the first place. When it comes to building a foundation for long-term investing, the S&P 500 stands out for several reasons. As the most widely tracked index in the United States, it represents 500 of the largest publicly traded companies spanning sectors like healthcare, finance, and consumer goods. This broad reach gives investors instant diversification across the core U.S. economy, all with a single investment. The result? You get exposure to the market's overall growth without the need to research or select individual stocks. The appeal goes beyond just convenience. Over the past decade, S&P 500 delivered an annualized return of 13.5%, turning a $10,000 investment a significant sum. This kind of historically its reputation as a reliable vehicle. For many, it's the default choice. Just buy an S&P 500 index fund and let compounding do the heavy lifting. But there's more to the story. While the S&P 500 offers broad exposure, it is not designed for income-focused investors. The index selects companies based on not dividend yield. That means while some of its holdings paid, the overall yield tends to stay on the lower side. If you're relying on your investments, whether you're in retirement or just want steady cash, S&P 500 simply doesn't prioritize companies with high or sector allocation is another important factor. On paper, the S&P 500 looks diversified, but in practice, it's heavily weighted toward technology. Tech giants like Apple and Microsoft have driven much of the index gain. This concentration cuts both ways. When the tech outperforms, the index benefits. Tech stumbles, the impact can be sharp. In fact, since 2016, the S&P 500 experienced a maximum drawdown of 23.9%, underscoring how sector content can amplify gains and losses. For investors who prefer a smoother ride or worry about volatility, this is something to keep in mind. Stability during downturns is another consideration. While the S&P 500 has bounced back from market corrections over time, these periods of steep decline can, especially if you're approaching retirement or need to access your funds soon. Watching nearly a quarter of your portfolio disappear during a downturn, even if you know markets tend to recover in the long run. This volatility is simply part of the package when investing in a broad equity. Despite these limitations, the S&P 500 is a popular choice for its simplicity. It's a straightforward way to participate in its overall growth, and for many investors, that's enough. But it's not always the best fit for every goal. If you want higher income or less reliance on one sector, you might start to wonder whether there's a tailored approach. Rather than sticking with broad market exposure and riding out sector swings, what if you could pair income and growth more strategically? That's the thinking behind combining ETFs like SC and SCH. By blending funds with different strengths, one focused on quality dividend payers, the other on growth leaders, you can build a portfolio that aims to address some of S&P 500's biggest shortcomings. This kind of combination doesn't mean sacrificing diversification or taking on extra risk. Instead, it's about using the right mix of tools to better match your investments, whether that's generating income, smoothing out returns, or capturing growth in new areas of the market. The idea is gaining traction for good reason. So what actually happens when you combine steady income with high growth potential? Let's look at how the SCHD and SCHG pairing works, and why it's catching the attention of investors looking for something beyond the standard index approach. Pairing SCHD SCHG means you're not just picking two random ETFs. You're building a portfolio where value and growth sit side by side. SCHD, the Schwab U.S. Dividend, focuses on high-quality dividend-paying companies. These are businesses with strong fundamentals and a solid track record of returning profits to shareholders. If you're looking for stability and a steady income stream, SCHD covers that base. The ETF is packed with companies from sectors like consumer staples, healthcare, and utilities, industries known for holding up even when the market gets rocky. It's a favorite for income-focused, and its reputation, a media darling, is well earned. The dividends SCHGs can help cushion Leo during downturns, offering a reliable payout even if share prices dip. On the other side, you have SCHD, the Schwab U.S. Large Cap Growth ETF. This fund is all about capital appreciation, targeting companies during innovation and expansion. SCHG leans heavily into technology and other fast-growing sectors, prioritizing future potential over current income. Think of the names leading the charge in tech, healthcare, innovation, or renewable energy. These companies may not always offer big dividends, but their share prices can climb quickly as they capture new markets. For investors who want a shot at higher returns and aren't afraid of a little volatility, SCHG brings that. With no overlapping holdings, this duo gives you exposure to 333 unique stocks, almost as many as the 500 in the S&P, but split across dividend stalwarts and growth innovators. SCHD overlaps 43% with the S&P 500, but adds roughly 6 unique stocks. SCHG brings dozens more high-growth names outside that index. This structure isn't just about numbers. It's about building a portfolio that's diversified in a way the S&P 500 isn't. Instead of doubling up on the same big names, you're spreading your investment across 2 separate pools of opportunity. This pairing hedges volatility with SCHD's dividends while capturing tech-powered upside through SCH. When markets get choppy, SCH steady payouts can provide some calm, helping to offset dips in share prices. SCHG, meanwhile, is positioned to take advantage of strong bull market, especially when growth stocks are leading the way. The push and pull between these two strategies can help balance out returns over time. It's a way to smooth out the ride, aiming to deliver both income and growth without putting all your eggs in one basket. Another key point is how these ETFs step outside the boundaries of the 100 approach. SCHD's overlap with the S&P 500 means you still get exposure to many of the market's leading companies, but its roughly 60 unique holdings are chosen for their dividend. SCHG, while sharing some names with the S&P 500, also includes a large group of growths that aren't part of the main index. This means you're not just following the crowd, you're tapping into segments of the market that a traditional S&P 500 fund might miss. The research backs up the logic behind this combo. SCHD delivers consistent income, while SCHG provides the potential for capital growth. Together, they create a portfolio designed to address more than one investing goal. Instead of choosing between income and growth, you get both. And you do so with a level of diversification that's hard to replicate with a single index fund. For investors, the appeal is clear. You're not just replicating the market, you're building a portfolio with its own strengths. By combining the steady cash flow of dividend payers with the upside of growth stocks, you can tailor your approach to fit your needs, whether you're looking for regular income, long-term appreciation, or a mix of both. Of course, the big question is how this approach stacks up in the real world. Does the SCHD SCHG combo outperform the S&P 500 when it comes to returns, risk, and income? The answer comes down to the numbers. Let's see what the data reveals when these portfolios go head-to-head. When you line up the SCHD SCHG combo against the differences become clear across returns, risk, and income. Using Portfolio Visualizer, we analyzed both portfolios from January 2016 onward, focusing on how they stack up in real-world scenarios. The S&P 500, represented by VOO, set a high bar with a 5% annualized return over the last decade. That's a return many investors would be satisfied with. and it shows why the index is such a trusted building block for long-term wealth. But the SCHD SCHG portfolio, split evenly at 50-50, nudged past that benchmark in 0.5% annualized return. At first, a single percentage point might not seem like a game changer. Yet, over 10 years, starting with $10,000, that difference grows your investment to roughly $35,000 with SCHD SCHG compared to about $32,000 with the S&P 500. That's a $3,000 advantage simply by balancing income and the power of compounding small annual edge into a meaningful long-term gain. Risk is always a concern, especially when a portfolio promises higher returns. You might expect the SCHG blend to be more volatile, but the data says otherwise. Both portfolios posted an identical standard deviation of 15.5%. In practical terms, this means the swings in value you'd experience over time would feel the same whether you chose the S&P 500 or the SCHD SCHG approach. For investors who want to boost returns but aren't willing to take on extra risk, this is an important finding. Of course, no investment is immune to downturn. Looking at maximum drawdown, the biggest drop from its lowest point, the S&P 500 fell 23.9% during the period analyzed. The SCHD SCHG combo dipped a bit more at 24.7%. On a $10,000 investment, that's just under $700 more in losses at the worst point. This slight increase likely reflects heavier tilt toward growth stocks, which can react more sharply during corrections. Still, SCHD SCHG managed to beat the S&P 500 on total returns and match its volatility, making that extra drawdown a reasonable trade-off for many investors. Income generation is where the SCHD SCHG duo really stands out. While the S&P 500 provides some dividends, its yield tends to be modest, since the index doesn't prioritize income. SCHD, on the other hand, focuses on companies with a history paying and growing dividends. When you combine SCHD's income with SCHG's growth, you get a portfolio that not only grows faster, but also pays out more along the way. For investors who rely on their portfolios for cash flow, like retirees or anyone planning to supplement their income, this difference is significant. The extra income can mean larger withdrawals or a slower drawdown of your principal, helping your savings last longer. Reinvesting dividends can create an additional layer of compounding. While both portfolios benefit from reinvested payouts, SCHD's higher yield means your reinvestments go further, adding to both your future income and your capital base. Over time, this can snowball a much larger portfolio, especially for those with a long investment horizon. We'll also see if a tech and healthcare twist can improve on the SCHD SCHG balance. Some investors are exploring a third option that blends SC with XLK, technology, and XLV, healthcare. This combination aims to capture the steady income of SCH while adding targeted growth and stability through two of the most influential sectors. Early data shows this 14.2% annualized return, just a shade below SCHD SCHG, but with a slightly lower standard deviation and a smaller max. That suggests it could offer an even smoother ride for those who value stability alongside growth and income. With these results in mind, it's clear that investors don't have to settle for the default. By thoughtfully combining each, you can build a portfolio that matches or even exceeds S&P 500 on returns, matches its risk, and delivers more income. But what if you could take these benefits a step further by fine-tuning your sector exposure? There's a growing interest in portfolios that build on the SCHD foundation with targeted growth and defensive sectors. Let's take a closer look at how this approach plays out and whether it could be the most balanced option for investors seeking growth, income, and resilience. Building on the idea of combining strengths, let's explore what happens when you move beyond the basics, a third portfolio option, a blend of SCH XLK, and XLV. This strategy takes the solid foundation of SCHD and enhances it with focused exposure to technology and healthcare, two sectors that have shown both resilience and growth potential. The result is a portfolio that aims for balance, targeting income, growth, and stability all at once. First, SCHD remains the anchor. It's designed around paying companies, which means you're getting steady income and a degree of downside protection. This is especially valuable in volatile markets where reliable dividends can offset drops in share price. But rather than stopping there, this portfolio adds XA and XLV for a more intentional sector allocation. XLK, the Technology Select Sector SDR Fund, brings in the innovation factor. Technology companies, think software, semiconductors, and IT services, often drive market gains during periods of expansion. By including XLK, you're tapping into a sector known for its rapid growth and ability to reach. This gives your portfolio a growth engine that can help boost long-term. Then there's XLV, SPDR Fund. Healthcare is considered a defensive sector, meaning it tends to hold well during economic downturn. People continue to need medical care regardless of the economic cycle, so this sector uses less volatility when markets get rough. XLV adds a layer of stability and, thanks to the presence of established healthcare companies, can also contribute to the portfolio's income stream. What makes this mix compelling is how each ETF complements the other. SCHD provides consistent dividends, XLK delivers growth, and XLV offers defensive stability. Together, these elements create a portfolio that's not just diversified by the number of holdings, but by the type of returns and risk it can handle across different market environments. Looking at the numbers, the SCHD XLK XLV portfolio posted an annualized return of 14.2% over the analyzed period. That's just a bit below the 14.5% from the SCHD SCHG combination, but still higher than the S&P 500's 13.5%. Where this portfolio really sets itself apart is risk management. Its volatility, measured by a 14.7% standard deviation, is the lowest among the three options. For investors who want a smoother ride, this matters. Even more striking is the maximum drawdown, 20.7%. For retirees, that 20.7% worst drop versus 24.7% with SCHD SCHG means keeping thousands more intact when markets tumble. During periods of steep decline, that smaller drawdown can make a real difference in both peace of mind and financial. Income generation is another major advantage. SCHD's dividend focus, paired with the stability of XLV, produces a stream of income that stands out compared to the S&P 500. While XLK isn't, its growth can help lift the overall portfolio value, balancing out the income side. For investors who need regular cash flow, whether to supplement a paycheck or fund retirement, this combination can provide larger and more reliable payouts. And if you're reinvesting those dividends, the compounding effect can help your portfolio grow even faster over time. Imagine you're approaching retirement. You want a portfolio that provides steady income, limits your downside risk, and still gives you a chance to participate in the market's growth. The SCHD XLK XLV blend fits this need by combining dependable dividend payers, a growth sector, and a defensive anchor. It's a design that responds to changing market cycles. XLK can capture gains during expansions. XLV can help cushion losses during downturns, and SCHD ties it all together with consistent cash flow. This approach isn't just about chasing possible return. It's about creating a portfolio that works for your. If you value stability but don't want to miss out on growth, or if you're focused on income but want to avoid large losses in bear markets, this third option offers a practice. Now that we've seen each strategy's strengths, S&P SCHD SCHG's income growth blend and SCHD XLK XLV's stability, let's decide which best fits your goals. Choosing between these ETF portfolios is about more than matching a benchmark. It's about shaping your investments to fit your needs. These ETF combos don't just match the S&P 500. They let you tailor returns, income, and risk to your life. Over the past decade, both the SCHD SCHG and SCHD XLK XLV portfolios delivered higher returns in many cases, along with benefits like steadier income and lower drawdowns. Which combo resonates with you? Pure S&P simplicity, income meets growth, or sector-engineered stability? Drop your pick in the comments. If you found this comparison useful, give it a thumbs up and subscribe for more research-backed portfolio insights.